Hey everyone, welcome back to the channel, your number one source for income-oriented investing, how to generate passive income from a diversified portfolio of high-yield funds. And speaking of high-yield funds, you guys know that one of my favorite types of product on the Canadian stock market are these all-in-one enhanced or leveraged covered call solutions. And today we're going to revisit the latest one that came out, BMAX. So I'm talking about the Brompton Enhanced Multi-Asset Income ETF, stock symbol BMAX. And today what I really want to do, because I've already done an in-depth analysis and breakdown of this all-in-one ETF and a Q&A with the ETF Senior Vice President, Cullen at Brompton, who's actually going to be joining us in this video as well. What I really want to do in this video is to really try to tell you what makes this one different from its three competitors. As we know, there are right now, including BMAX, 4 all-in-one leveraged all-in-one covered call ETFs out there. So it could be hard to really figure out which one is best for you. So I really want to try to tell you what makes this one or sets this one apart from its competitors. And then we're going to do a quick follow-up with Cullen again, a returning champion from Brompton, and ask him a few important questions which I feel are on everyone's minds right now and typical when this style of ETF comes out. So the thing I'm going to talk to him about, which is very important, of course, is dividend or distribution sustainability. How sustainable are these monthly high dividends currently at 10 cents a month for BMAX? We're going to talk about the MER because I know I got a lot of questions about the MER. And we're going to ask him really also about the covered call strategy that Brompton uses and how it's really different from some competitors. So let's get into it right away. All right, let's quickly review the BMAX ETF together, everyone. I'm not going to spend too much time here because I've already done an in-depth analysis. If you're interested, just go in YouTube, and if you just search BMAX ETF review, you'll see my video there, a nice Brompton podcast, which talks about BMAX in detail. And also the third video is my Q&A with Cullen from Brompton. So make sure to check those out if you're a bit newer to this ETF. But what I really want to try to hit on, first of all, let's just check real quick what the current price and yield is. So this ETF is currently giving out a distribution just like the original distribution of 10 cents a month. So right now it is the end of the stock market. The stock market is closed on May 25th, and BMAX ended at 12.21. So 10 cents times 12 to get the annual is $1.20. $1.20 divided by 12.21 will get us our yield. So the yield is a little over 9.8%, everyone. So just under 10% yield, very high yield here. And when it comes to what's inside of it, this is really what makes BMAX different. So this is really my opinion on why I feel BMAX is it could be different from its three competitors. The first thing that's very important to understand, here is the breakdown of the ETF. So of course, this is an ETF that holds other Brompton ETFs and products because it is an all-in-one. And what you will see is that unlike its three competitors, where it's 100% stocks or 100% equity, BMAX is only 70% equity, so 70% stocks or 70% covered call ETFs, which have equities inside of it, and 30% will fall under the fixed income window. So what does that 30% fixed income allocation look like? Well, 20% of it is in the Brompton investment grade preferred ETF. So this one here, 20% of BMAX is this ETF. And if we scroll down and look at this ETF on their ETFs list, it's this one right here that has currently just under 6% yield. And this is fixed income, guys. This is US preferred shares. So preferred shares, as we know, is kind of like a hybrid between stocks and fixed income. It does fall under the fixed income umbrella. So it's a lot more stable, a lot more defensive. And the other 10%, sorry, this is the management fee, which I'm going to talk about in a second. The MER is 2.59%. So you might be thinking, well, that's a little bit high. I'll ask Chris about it and I'll give you my opinion about that in a second. But before we go into that, if we go back to the breakdown, the other 10% is going to be right here in various split share preferred shares from Brompton. So split share funds, everyone, I've spoken to, made many videos about them. As we know, there's two types of shares. There's the Class A shares. Those are the ones that use leverage, that are highly volatile. But then there's the very stable and boring preferred shares, which in my opinion are a great replacement, or not replacement, a great alternative to GICs or cash, for example, because they're very, very, very stable. They give eligible dividends instead of ordinary income. So that's where the other 10% is in the just a couple of different Brompton split share preferred funds. So that's where the 30% fixed income comes from. The 70%, the remainder, is in 7 of Brompton's covered call ETF. So let's check them out real quick. You have a technology one, so all the big technology companies, European dividend growth, so big cap dividend grower companies or dividend growers, which are basically dividend stocks that tend to grow their dividends over time in Europe. So you got some great regional diversification there, which the its competitors don't really have as much international exposure, if any. Then the next one, the third one, North American low volatility dividend ETF. So low volatility is lower risk, lower volatility. So a lot of defensive sectors in here, a lot of healthcare, consumer staples, utilities, things like that. So very, very defensive. Speaking of defensive, the next one is also, you could consider it defensive, sustainable real assets dividend ETF. So these are all real assets types of stocks. So there could be utilities in here, industrials, there could be a little bit of real estate, power generation, water treatment centers, airports. I like to refer to real assets as salt of the earth, essential infrastructure type companies, things that are really, really boring, that don't get much attention, but are very, very stable. Then there's the global dividend growth ETF. So like the name says, best dividend stocks, blue chip dividend stocks all around the world. Healthcare, very defensive, healthcare stocks, and North American financial. So all the top financial companies in North America, not only banks, but also life insurance. So what you will notice is that, so 30% in fixed income, very safe, very stable, and boring. I know many people like boring, but another thing you need to remember is, out of the 7 ETFs, this one here, North American low volatility, the sustainable real assets one as well, the healthcare one, these are, all 3 of these, I consider them very defensive. So right now we're up to 60% of this ETF in very defensive assets or defensive stocks or asset classes. So if you even count, the global dividend one has about 20% of it is in defensive stocks. So over 60% of this ETF, everyone, is in what you would call defensive assets or defensive stocks. So this is really the first thing that's really different from the competition. I think if you're more of a conservative investor that really wants more stability, you're okay with leverage. And here's another thing that's different. This one, BMAX uses 33% leverage instead of 25% leverage. But because so much of it is defensive, I think it doesn't really add that much extra risk, just 8% more leverage in the competition. This is, remember, you're leveraging what's inside of it, and this is very, very defensive stuff. Over 60% defensive. Another thing is that the diversification here is incredible. Not only do you have sector diversification, that's obvious, right? You have a bunch of sectors here. You pretty much have everything. You're also diversified by asset class, because you got some fixed income, stocks, or equities, and even that split share fund preferred. So you have asset class diversification, sector diversification, but also regional diversification. So the global dividend, the global one here, has international companies as well. And you also have this one here, the European 10% in here. So give or take, you're looking between about 15% outside of North America. So regional diversification, asset class diversification, and sector diversification. So very, very diversified in every which way. Very, very defensive. I think that's what really makes this one different from the other 3 from the competition. Great for if you're looking for stability long term. You don't like a lot of volatility in your portfolio. It does have leverage though, 33% leverage, which translates to an MER of 2.59%. Now that seems rather high. The competitors or for similar products are at about 2% or a little over 2% MER. But my guess is that extra 59% comes from the additional leverage. So don't forget, guys, this MER includes leverage costs. So if you would invest or take leverage in a margin account yourself, you got to pay that interest rate, right? You got to pay those leverage costs. Well, those leverage costs are included in the MER, and that's why it seems high. But don't forget, they include the leverage cost. So now let's talk to Chris Cullen. Let's do a catch up with him. Let's ask him about the MER. By the way, ask him about it. Let's ask him also about the Bromptons view of things, of their covered call strategy, because they have, like I showed in, or like I discussed in the first Q&A, they have a more conservative view of covered calls. They don't write very aggressive covered calls. And we'll also ask them about, of course, the super important distribution or dividend sustainability. All right, everyone, welcome back. So we are joined by Chris Cullen, Senior Vice President at Brompton ETFs, Head of ETFs. So Chris, welcome back, our returning champion. Always appreciate you having you on the channel. And today we're going to talk about an in-depth on the BMAX, of course, Brompton Enhanced Multi-Asset Income ETF, which has been gaining a lot of AUM and assets over the course of the last months. How are you doing, my friend? Welcome back.
I'm fantastic, Adrian. Thank you so much for having me back again. It's always a pleasure to join you here on your channel.
Yeah, it's great to have you. So let's get into it right away. So in the first half of the video, I do an in-depth analysis of BMAX. And for my audience, in case you don't know, we've already done a Q&A on BMAX already, a review on it, digging into the assets inside, the strategy. So today our question is going to be a little bit different. They're going to be more about questioning what's inside of it, but also mostly the dividend or the distribution sustainability, which is very important for my audience because we're income investors. So, Chris, let's start right off the bat from on BMAX composition, right? So you guys decided that this is not going to be a 100% equity or stocks product. So you guys actually have BMAX at 70% in covered call equity or covered call strategy or stocks and 30% in fixed income instead of 100% in covered call equity, which is what most of the competition is doing when we're talking about other enhanced or leveraged all-in-one ETFs. So why did you guys decide to do this when we know that long-term fixed income tends to underperform equities?
Sure, yeah. We absolutely did that. We have 20% allocation to US dollar prefs on a
Yeah.
CAD hedge basis, and we have a 10% allocation to split share prefs, which are a specialty product issued by some of our split share funds. So the reason we did that was deliberate, Adrian. Yeah, we're cognizant that fixed income will underperform. It might underperform less than you may think. I think over a long term, equities tend to perform somewhere in the 7-8% range per annum. Fixed income has performed at a lower level, but 5 to 6% would be a reasonable level for fixed income for expectations. And you got to remember too, that's on a gross basis. We like to think of investments as providing returns for taking on a level of risk. And fixed income, particularly these types of preferred shares, have quite low risk in terms of their standard deviation of returns. So volatility is quite low on these two types of preferred shares. These are both distinctly different than Canadian corporate preferred shares, which have had a different type of volatility profile, which has been a little more nerve jangling for investors. So we're trying to take our equity covered call programs, which are a little bit toned down in terms of risk because of the covered call positions that the funds take on, and further stabilize that portfolio by adding in fixed income. And it's kind of the same idea as some people want a growth equity fund. A lot of people look to balanced funds just because it helps them sleep better at night and provides a healthy level of yield. So that's where BMAX fits into this fund of funds landscape.
Yeah, I like that word stability, right? That's exactly what it does in my opinion as well. So you kind of already actually just touched on it right now, the covered call strategy. So I think, and we've spoken about this before in our previous Q&A. Brompton has more of a, not as an aggressive or a more conservative covered call strategy, which means you're basically writing less or maybe a bit further out of the money, right? So this actually tends to have, obviously you have less yields, but a little bit more upside. So tell me about Brompton's view on, generating covered call premiums, but also having a lot of upside, because I think that is your basic premise behind your covered call product. So tell me a little bit about that.
Yeah, that's what we're trying to do. What we're trying to do, and no offense to any of your other channel participants or my competitors, but what we're trying to do is just take a realistic view of what can be done with a covered call strategy. Now, when you have a portfolio of equities, You can go and write a short-term call on the majority of these equities. You can write close to the money even, and generate very high premiums. And if we took that and we paid it all out, what we believe we'd find is over the long term, the NAV of the portfolio would grind down and grind down. The reason for that is that when you open a position that's a cover call position by buying equities and selling calls, that's not the end of the story, right? You've got a nice premium and you're holding these equities. The equities over that time frame, they could shoot up and get exercised on the portfolio, and then you got exercised at a price that's below the current market price. You have to go back in the market and buy at a higher price. There's a cost to that. So that's just one example, I think, of the costs that are, I believe that they're ignored to a large part in the cover call space. So again, what we're trying to do is just try to put our version of reality into this cover call product, and we're paying out levels of yields which in the regular equity space are unheard of. Right, like I think our ETFs average 6.5%. You don't get that out of a dividend ETF. Much more modest yields. So we're paying out what we view as being a very generous yield. We're paying out what we view as being a realistic yield. Equities over the long run yield maybe 7 to 8% if you look back, say, over 100 years. You can't turn that into a 13% yield by writing a few cover calls. You might be able to pick up 1, 2, 3% if you're very good and you're very careful on how you write. So we think that we're quite good, and our PMs are very careful, and that's more or less what we're trying to deliver here. We're trying to deliver a product with attractive yield that's not unrealistic in terms of sustainability, and that still retains some upside. It's still an equity product first, but with enhanced cover call distributions.
Yeah, and I think this is going to be music to a lot of my listeners' ears, because I think the number one concern or worry that I typically get all the time throughout the 3 years of this channel is NAV erosion, NAV grinding, or stock price just keeps going down and down because the yield is very aggressive. So to that, I always say you got to calculate a total return. Okay, you can't just look at the stock chart. But for some people, they just can't handle it. They would rather have less yield and a little bit more stability or upside with the stock price. So I think BMAX is a great option for those more conservative investors, not necessarily conservative, but more people who are watching the NAV and just cannot stand or cannot see it go down. So I think you guys have a winner here. So next question or two is going to be what I think is the most important thing, especially for income investors. Always hear this, always a worry on everyone's mind: distribution or dividend sustainability. How can you sustain your yield? How is it possible? So I kind of did the calculation myself, and you actually just mentioned it. If you combine all the products in BMAX, more or less approximately, it's about 6.5% yield, something like that. But BMAX offers 33% leverage, which will get you to about 8.5 or just under 9. But BMAX is actually giving a yield of just under 10 approximately right now. So what would you say to people who are worried about dividend or distribution sustainability? Can you sustain these current 10 cents a month distributions, which is your original amount, and you guys are just, so far you've left that at 10 cents a month? What would you say to those investors? How sustainable are those 10 cents a month distributions?
Well, absolutely sustainable, I would say, in my mind. I hope I'm not overstating it. I mean, it's never a guarantee. I want to just mention that for any investment fund, whether there'll be any returns at all. But we view this as a very sustainable approach to paying out distributions. I'd mentioned that our equity funds, especially, are you could think of it as holding back slightly because we want to protect the NAV, because we want to provide some growth and some upside. And when you marry that idea with BMAX and the philosophy around BMAX being to introduce some stability, we think that there is definitely the room in the holdings for BMAX for BMAX itself to pay a slightly higher distribution than the average for its holdings would imply.
Okay.
And again, that reason is just that for our equity cover call funds, we're making the decision really in BMAX to pay out a bit more of the capital potential to the tune of maybe 1% on average to get the BMAX yield up to 9.5%. So hopefully that makes some sense to you. We think that it's sustainable because we think that we have held back some capital growth in our underlying equity ETFs NAVs, and so that's kind of working into the payout for BMAX.
No, it does make sense because you have a less aggressive cover call strategy, which means more capital gains, more stock price upside, and of course, I did the review in depth. These are all quality assets inside of BMAX, or mostly all, especially that 70% equity. It's all big cap, blue chip, mostly dividend payers that tend to grow, dividend growers that tend to grow over time. So that's a really great answer. So let me ask you in another way, maybe. If all the assets inside of BMAX, because of course BMAX is an ETF that holds other ETFs and other things, if the distributions remain relatively stable and the same with those assets, is it safe to say that most likely BMAX will continue to have the same level of distribution, and it's very sustainable if the funds inside
Yeah,
are stable as well?
our plan is to keep it at this level of distribution, and we believe that it's a sustainable level of distribution due to the nature of the funds, as I've already kind of given you an overview for.
Fair enough. Last question, Chris. I won't hold you. Management fee and MER. So the MER, if we look at just a document on your website, I think it's called the ETF Facts document, has it at 2.59%. So this is a little bit higher than similar products out there. Is it because there's a little bit more leverage? That would be my guess. Is that why it's a little bit higher?
Yeah, that's exactly it. I mean,
Okay.
when looking at our competitors, BMAX has a bit more stability because of the fixed income that's included there. So we added a little bit more leverage than our competitors, and really what it works out to be is 8% extra leverage. They're paying 25% or they're borrowing, sorry, not paying, they're borrowing 25% of NAV, and we're borrowing 33%. And the difference in cost of that leverage at today's rate, I mean, we got an overnight rate that's somewhere around 5%. That works out to be exactly the 59 basis points
Oh, there
that
you
you see
go.
as far as the
Okay.
difference. Yeah,
Okay,
yeah.
yeah, because the other ones are approximately more or less two, maybe a little bit over 2%
Mm.
MER. So it's the same thing. It's because of the extra leverage cost. So I'm talking to my audience here. You guys have to remember that yes, these MERs seem high, but they have borrowing costs, leverage costs are included inside them, and it's a
Yeah.
very high percentage of the MER. Just like when you borrow money in your margin account, you got to pay that 5% extra, right? So that's included in the MER. Make sure not to forget that. So, Chris, I think that's all the questions I've had. This was great. I think BMAX is a very interesting product, very unique compared to the competition. My personal opinion here, I think it's probably going to be the most stable, the most conservative one, and a lot of people are looking for that stability in their portfolio that they could just hold long term. And very diversified in every which way, asset classes, sector, and region. So I think you got a winner. I wish you luck with this product. I know it's been every month I go and check, there's like an extra 20-30 million AUM. So I think it's going to be a hit. So thanks so much for doing this, and appreciate you coming on.
Anytime you got time to spend chatting with me, Adrian, I'm available, and just thank all your viewers as well for their interest.
Sounds good. We'll have you back. We'll have you back for sure. Take care.
Fantastic. You too.
Hey, don't go yet. A few reminders before you leave. Did you know that I launched a YouTube loyalty membership program where for only $3 a month, you could become a PII Inner Circle member, where you will gain access to exclusive content, exclusive videos and live streams, as well as other perks and benefits, including a really cool weekly opportunity report. That's right. If you're interested, just click on the little join button next to the subscribe button to see what it's all about. Also, make sure to follow me on Blossom and download Blossom. It's a social investing app, which is really cool. You could share your portfolio, follow other people's portfolios, including my own. My username is Adrian_PII. So download it with the referral link below. Not only is it free, but you could actually earn cash by taking these really small, quick 1-minute courses. Really awesome. It's a no-brainer. Also, make sure to visit our website, passiveincomeinvesting.ca. That's where you could book a one-on-one private coaching session with yours truly, with myself, where you could ask me all the questions you want. All the information and booking information is on the website. Make sure to check out that video on the homepage there to see how to book a one-on-one properly. Also on my website, you could purchase my digital product, which I'm very proud of, the Ultimate DIY Investing Package. This is a reference tool or a companion tool that will help you build your own portfolio. So it has lists of funds, it has sample portfolios, and it covers both the Canadian and US stock markets. And the good news is you'll only ever have to buy it once because it comes with free lifetime updates. And my plan is really to update the version every single year. So make sure to pick it up. Also, I have Questrade and PASSIV referral links below. So Questrade is the broker that I personally use, and PASSIV is the broker companion tool or assistant that I use. Really cool program, really cool software. So I have referral links for both of those. Questrade, $50 of free trades. And PASSIV, I have half off for the elite membership. If you're interested in the elite membership, and even if you want to start out with the free membership and upgrade to the elite afterwards, use my referral code so you could still get that 50% off. And don't forget that the elite membership of PASSIV is 100% free if you use Questrade. For social media, we have a very successful and big Facebook group, private Facebook group with over 14,000 members where we all try to help each other out. So make sure to join that group. Information is below. We also have Instagram where you could follow us or more personal stuff when it comes to our life here in Panama. And there's LinkedIn as well. So as usual, everyone, how do I leave you? Continue to stay safe, stay healthy, and of course, stay passive. See you next time.